What if I told you that the greatest living investor believes the United States dollar may be at risk? Warren Buffett, now 94 years old, has returned to the spotlight after revealing his latest moves in Berkshire Hathaway's official 13F filing. This is not just about buying or selling stocks. It is a warning. A warning he already made clear before thousands of shareholders at Berkshire's annual meeting in May 2025, when he stated that the U.S. government's fiscal policy is what frightens him most, and that the natural course of politicians is to make the currency increasingly less valuable, according to the official transcript published by Berkshire Hathaway. These words resonate even more strongly when we recall that, according to the U.S. Treasury Department, public debt surpassed $34.2 trillion in January 2025, the highest level in the nation's history. A figure that grows every second, leaving one inevitable question hanging. How long can the system withstand such pressure? Buffett is not one to issue warnings lightly. During the 2008 crisis, when banks were collapsing, he was one of the few who maintained liquidity and seized the opportunity to acquire strategic assets at fire sale prices. Now, by repeating the same cautious posture, hoarding cash and trimming stakes in market giants, he suggests that another storm may be forming. The signs are everywhere. The Bureau of Labor Statistics reported that consumer inflation in the United States ended 2024 at 3.4%, above the Federal Reserve's 2% target, and more. Data from S&P Dow Jones indices revealed that as of April 2025, just 7 companies represented more than 30% of the entire S&P 500. Can a market so dependent on so few names really be considered healthy? Buffett looks at this landscape and sees a simple but devastating risk. When governments cannot pay their debts, they resort to printing money, and that means each dollar loses value in the hands of ordinary citizens. His own investment choices suggest that this is not mere theory, but calculated action. The question remains, will we continue to treat this as just another opinion, or will we finally recognize that Buffett is showing us, in real time, how to prepare for something that could change the course of the global economy? The big sales and the cash pile. When an ordinary investor sells a few shares, it rarely attracts attention. But when Warren Buffett decides to trim long-held positions, the entire market must stop and listen. In the second quarter of 2025, Berkshire Hathaway cut more than $4 billion worth of Apple shares, reduced its exposure to Bank of America by over $1 billion, and completely exited T-Mobile, according to official data disclosed in the 13F filing submitted to the Securities and Exchange Commission. These are not small adjustments. They represent a clear withdrawal strategy. And that was not all. For the 11th consecutive quarter, Berkshire sold more than it bought, expanding its mountain of cash and short-term securities, which now exceeds $134 billion, the largest pile in the company's last 60 years, according to Berkshire's 2024 annual report. For Buffett, cash does not mean fear. It means ammunition. Ammunition for when the market reveals opportunities that today remain invisible. But why would someone who has always championed long-term investing be pulling so much money out of stable giants like Apple or traditional banks? The answer may lie in Buffett's own logic. He has declared in several shareholder letters that he prefers to wait patiently until opportunities get down on their knees before him. This metaphor describes the moment when solid assets are forced down to prices well below their real value. Think about everyday life. How many times have you seen something that looked too expensive, only to find it on clearance months later? Buffett does exactly that, only on a billion-dollar scale. He sells when he believes prices are inflated and holds onto the capital to buy when the market crashes. Interestingly, this mindset is not restricted to professional investors. A regular worker can also benefit by setting aside part of their monthly income and investing only when truly attractive opportunities arise. What Buffett is showing us is that behind the image of the patient investor lies a defensive strategy that may be anticipating a much bigger shock on the horizon. After all, if even the most prestigious assets are being sold off, what does he know that the rest of us do not? And it is precisely to decode these signals that we move forward in the next chapter. If you want to keep following this analysis with data and facts rarely covered in mainstream news, subscribe to the channel now and leave your like on this video. By doing so, you not only strengthen this space, but also prepare yourself with real information for the uncertainties ahead. The two major threats driving his strategy. What could possibly worry an investor who has lived through the Great Depression, the oil shocks, the dot-com bubble, and the banking collapse of 2008? For Warren Buffett, two threats outweigh all others today: a market inflated by debt and the unsustainable growth of U.S. public debt. The first danger is visible in the charts. Data from FINRA, the Financial Industry Regulatory Authority, shows that the volume of stocks bought with borrowed money, known as margin debt, reached more than $750 billion in early 2025. This means that a large share of the market is propped up by credit, not real capital. It is as if countless investors were gambling with chips that are not their own. But what happens when the system freezes and lenders demand their money back? Buffett is also paying close attention to market concentration. Just 7 companies, all tied to technology and artificial intelligence, make up more than 30% of the S&P 500, according to S&P Dow Jones indices in April 2025. This heavy dependence recalls the dot-com bubble of the late 1990s, when a handful of companies pulled the index upward until everything collapsed. Are we witnessing history repeat itself? But there is a second, deeper risk. The U.S. Treasury Department confirmed that federal debt surpassed $34 trillion in January 2025. For Ray Dalio, founder of Bridgewater Associates, that figure could reach 55 or even 60 trillion within a decade, as he wrote in an analysis published on his official profile in 2024. What happens when the world's largest economy owes more than it can produce? Buffett has already given the answer. Governments do not declare bankruptcy. They print money. And printing money means diluting the value of every bill in circulation. That is exactly what happened in the 1970s, after the United States abandoned the gold standard in 1971. The following decade was marked by double-digit inflation that eroded wages and household savings. Could we be heading toward a similar scenario? These two factors, private leverage and public debt, form the perfect storm, a market dependent on credit and a government dependent on monetary expansion. What happens if both pillars weaken at the same time? It is in this context that Buffett's choices start to make sense. He is not simply hoarding cash out of caution. He is building a defensive plan against risks that could reshape not only Wall Street, but also the finances of every household. The new investments and the hidden pattern. What if I told you that behind the billion-dollar sell-offs, Warren Buffett has also been quietly making purchases that reveal an almost invisible pattern? At first glance, they seem like ordinary acquisitions. But when you look deeper, each one points to a well-defined plan shaped by the risks he sees ahead. In the most recent filing submitted to the Securities and Exchange Commission, Berkshire Hathaway disclosed 4 new positions: Allegion, a company specializing in security and smart locks; D.R. Horton, one of the largest home builders in the United States; Lamar Advertising, focused on outdoor media; and Nucor, a giant in steel production. In addition, Buffett increased his stake in Chevron, one of the world's largest oil companies, by more than $450 million, and surprised the market by investing about $1.6 billion in United Health Group, the country's largest health insurance company. What could possibly connect steel, oil, advertising, and healthcare? It might not look obvious, but the logic is crystal clear. All these companies share 3 traits. They are capital intensive, they generate strong cash flows, and they were bought at prices below market averages. Nucor's own financial report shows that the company recorded more than $6 billion in net profit in 2024, even with the slowdown in U.S. construction. Meanwhile, D.R. Horton reported delivering over 82,000 homes that same year, according to its annual report. These figures highlight resilience even in adverse times. But here's the challenge. Why would Buffett buy into cyclical industries just as so many analysts predict a market cooldown? The answer lies in the value of tangible assets. Machines, factories, land, and infrastructure either hold or increase in value when the currency loses purchasing power. That is the exact opposite of purely digital businesses, which depend on confidence and market optimism to sustain their valuations. There is also an apparent contradiction. Buffett sold off technology companies and banks, yet he made a heavy bet on healthcare with United Health Group. Does this break the pattern? In fact, it doesn't. He bought precisely when the market punished the stock, driving it well below its historical value. The result? Once the purchase was revealed, the stock surged 17% within just a few days. The pattern is clear: security, real assets, cash flow, and discipline on price. The bigger question is, why would Buffett be building this kind of defense now, precisely when many still believe the U.S. economy is strong? Tangibles versus a weak dollar. Imagine owning a machine that doubles in value without you doing anything. It sounds exaggerated, but that is exactly what happens when you hold physical assets during times of inflation. This logic explains why Warren Buffett is betting on companies that own land, factories, machinery, and heavy infrastructure. According to Nucor's financial statements, in 2024, the company invested more than $2 billion in new industrial plants. If inflation cuts the dollar's purchasing power in half, the cost of building those same plants nearly doubles. For those who already own them, the asset automatically appreciates. The same principle applies to real estate. According to the Federal Housing Finance Agency, average home prices in the United States rose nearly 40% between 2019 and 2024. Homeowners saw their wealth grow effortlessly. This reasoning repeats across other sectors. Chevron, for example, posted a net profit of $36.5 billion in 2024, according to its annual report. Oil does not rely on digital confidence or market narratives. It is a physical, irreplaceable asset used daily in transportation, industry, and energy. In weak currency scenarios, barrels of oil and tons of steel become even more valuable precisely because their replacement costs skyrocket. But Buffett's strategy is not limited to commodities or construction. United Health Group, although not a capital-intensive company, generates an annual cash flow exceeding $20 billion, according to its 2024 earnings report. For Buffett, this level of predictable cash flow functions as an invisible asset, strong enough to support the company even in turbulent times. The micro-conflict is clear. While ordinary investors chase fast-growing companies in overheated sectors like artificial intelligence, Buffett is turning to industries that seem outdated but carry something essential: tangible value. Who is really right? History offers clues. During the 1970s, when U.S. inflation surpassed 10% annually, sectors like oil and metals vastly outperformed the fledgling technology market. By repeating this logic today, Buffett is reminding us of a basic principle. When the currency loses strength, concrete, steel, and energy gain weight. But does this strategy hold up under any scenario? Or is there a risk that even tangible assets may fail to protect investors in the face of a new crisis? Lessons from history and the risks ahead. What if all this preparation by Warren Buffett turns out to be unnecessary? That is the provocation dividing economists and investors. On one side, some believe inflation will remain under control. On the other, voices like Buffett's argue that the risk of dollar devaluation is real and growing. Who is right? History helps frame the dilemma. A study published by research affiliates in 2023 showed that sectors based on physical assets, such as oil, steel, and electricity, outperformed the broader market in nearly every period when inflation exceeded 5% over the last 50 years. Another analysis by AQR Capital Management, one of the world's largest quantitative investment firms, found that portfolios with exposure to real assets consistently delivered superior returns in inflation-stress scenarios. In other words, the numbers support Buffett's logic. But today's signals are contradictory. The Federal Reserve insists it will not cut rates until it is certain inflation is contained. Jerome Powell reaffirmed in June 2025 that it is preferable to hold rates higher for longer than risk reigniting inflation. Yet banks like Goldman Sachs project that inflation is already on a downward path, and that rate cuts could begin as early as September 2025. If that happens, might we see the opposite of what Buffett fears, a slowdown instead of renewed inflation? This conflict leaves a gap of uncertainty. According to the International Monetary Fund, U.S., debt has already surpassed 122% of GDP, a level close to what was recorded after World War II. The difference is that in the post-war era, the country was entering a cycle of reconstruction and rapid growth. Today, it faces an aging population, recurring fiscal deficits, and dependence on foreign financing. Can an economic superpower keep spending indefinitely without consequences? Buffett summarizes the dilemma in a line he repeated in his 2025 shareholder letter: "Paper money can evaporate in value if fiscal policy fails." What may sound like exaggeration gains weight when we recall that global trust in the dollar rests less on fundamentals and more on the perception of stability. But how far can that confidence stretch before it breaks? And if the engine that drives the global economy is on the verge of failure, how should each investor prepare? The casino versus the cathedral. Warren Buffett often says the U.S. economy is like a magnificent cathedral, built over centuries of innovation, labor, and productive capital. But attached to this cathedral is also a noisy casino, where investors speculate, gamble, and distract themselves with easy gains. His warning is clear. If the casino overtakes the cathedral, the entire structure may collapse. The numbers confirm this metaphor. Today, the combined market value of the 500 largest companies in the S&P 500 has already surpassed $40 trillion, according to S&P Dow Jones Indices data published in April 2025. Yet much of that wealth is concentrated in a handful of names and fueled by expectations of future growth rather than real, tangible assets. At the same time, the U.S. government itself carries a debt that already exceeds $34 trillion, according to Treasury Department figures from January 2025. It is like building a cathedral on sand. But what does this mean for us, ordinary investors? It means you do not need billions to apply the same logic. Setting aside part of your monthly income, investing in businesses that produce real cash flows, and maintaining discipline in the prices you pay are all steps available to anyone. It is the individual version of Buffett's strategy: patience, prudence, and a focus on assets that hold value even when the winds blow against you. Of course, there are no guarantees. Not even the Oracle of Omaha can predict the future. But he shows us something even more valuable. It is not about guessing. It is about preparing. As the International Monetary Fund highlighted in its March 2025 report, U.S. public debt has already exceeded 122% of GDP, a historically dangerous level. The future of the dollar may not be guaranteed, but the ability of each of us to protect ourselves is within our control. If the economy truly is a cathedral, we must ensure it remains standing. That means supporting real businesses, the ones that generate tangible value, rather than placing all our chips in the casino of speculation. Buffett has already made his choice. The question is, what will yours be? If you believe this reflection brought value, subscribe to the channel, like this video, and leave your comment. Your participation strengthens this community and helps us continue bringing grounded, independent analysis. Thank you for watching, and be prepared. The next chapters of this story are still being written.